Welcome to the Techno Fundamental Report for April the 16th. Focus investing, we talk a lot about it on this particular web page. Warren Buffett, third edition called the Warren Buffett Way. So I took a section out of it here and put it up here. I said the essence of focus investing can be stated quite simply. Choose a few stocks that are likely to produce above average returns over the long haul, concentrate the bulk of your investments in those stocks, and have the fortitude to hold steady during any short-term market gyrations. Easier said than done, but that's exactly what we're trying to do, is to have just a few good stocks that we really understand. It said if you're a know-something investor able to understand business economics and to find 5 to 10 sensibly priced companies that possess important long-term competitive advantages, conventional diversification makes no sense for you. So in other words, what's wrong with conventional diversification? For one thing, it greatly increases the chances that you will buy something you don't know enough about. Know-something investors applying the Buffett tenets would be better to focus their attention on just a few companies, 5 to 10. Most of these mutual funds and most of these broadly diversified portfolios out there, they could be 10, 20, 30, 40, 50 stocks. The index funds have 500 stocks. So Buffett would be, saying if you're not in a position to really handle 5 to 10 companies, then maybe you should do a broadly diversified mutual fund. The way he kind of puts it with his strategy is, he says, go back to the 1970s. And if you were, let's say, in East Baton Rouge Parish, and you owned a car dealership, and you also owned a dry cleaning business, and you owned a bank, it was all you could handle. And you were doing quite well. You were incredibly successful. So the point he's making is that you need to find 3 to 5 good businesses, and basically applies that way with the stock market. William O'Neill talks about this in his book, How to Make Money in Stocks, The Red Dress Story. It says, investing in the stock market is really no different from running your own business. So let's say you've bought and stocked women's dresses in 3 colors, yellow, green, and red. So you're basically owning a woman's clothing store. So the red dresses go quickly, half the green ones sell, and the yellows don't sell at all. What do you do about it? Do you go to your buyer and say the red dresses are all sold out, the yellow ones don't seem to have any demand, but I still think they're good because yellow is my favorite color, so let's buy some more of them anyway. So what he's saying there is that if you've got 3 stocks and the red dresses are selling and doing well, buy more red dresses, don't buy more yellow dresses. Anyway, interesting story. Our dependency on oil has dropped tremendously since 1950s. You can see here was the energy intensity, which measures how much energy a country requires to produce $1 of economic output. So you can see that, with technology and the improvement in automobiles and the fact that we've gone to more of a service versus manufacturing economy, our demand for oil is dropped fairly dramatically. So when you think about what's going on with the spike in oil, and we'll talk a little bit about that, it's not going to impact the economic situation as it would have done back here in the 70s, which was the oil embargo. So let's take a quick look at the follow-through day. Now remember what a follow-through day is. You're looking. Just think of what the word follow-through means. We want to see where institutional investors come into a stock, and then they are the market, and then they follow through with additional buying. So like back here, this is 2020. It's just an example. We came down, we made the low, and then we had, the first day of the rally attempt, 1, 2, 3, 4. Then once you get past that 4th day, you then change your verbiage from rally attempt that you're now in a rally. So you can see the rally somewhat faded, which was totally normal, and then we got the follow-through day, and then we continued the rally. So that was in the year 2020. So let's look at how we look today. Now, I've kind of shortened the graph so you can clearly see it. Now, the volume has not been incorporated in yet, but I can tell you we're not going to have higher volume today than yesterday, and this is yesterday's volume. So here's our low in the NASDAQ. We've now got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We are in the 11th day of a rally. So that would tell me the next thing I would be looking for would be something called a power trend, which is something that requires additional, and actually I should do it on another video, but it means that we've got to continue this trend to get a power trend. Now, if you look at the S&P 500, you can see, we did get the higher volume. We've made the low 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11th days we're in this rally. So it's getting a little long in the tooth. We're making new highs and everything. This thing will probably cool down a little bit. We'll just have to see. But I did want to mention, our growth tides, where we look at growth stocks versus, the consumer staples and defensive areas. So we're taking a ratio here of aggressive to defensive. So as you can see here, and I mentioned this, back at the beginning of the year, I said this is an early warning system that's telling you that the market's getting in trouble. Just think about it. When the institutions start buying consumer staple stocks and dumping their technology stocks, it tells you that they're worried about something. So as you can see here, this thing came down, made a nice base, then started making higher lows and higher highs. You can see breaking out very nicely, and you can see what's happening with the market. So again, it's an early warning system when things are looking troubling, and it's also an early warning system when things are looking better. You want to get above both moving averages, and you want that lower moving average right here to turn up, and it has. So let's look at another example. Here's the NASDAQ compared to a low volatility ETF. Again, same story. We're breaking out. Looks pretty darn good. Here's ARK Innovation, which is a very high growth type of mutual fund, or ETF, excuse me. And you can see here that it has broken out and looking very positive. So I wanted you to also see kind of a long-term picture here on this particular indicator, because this has been a very good one. This goes back to the bear market of 2022. You can see here where we got the early warnings when we started breaking below those moving averages, failing to really get going, breaking below the moving averages, and the market got in trouble and we went into a bear market. Same story here. We broke down, but we've since consolidated and we've gotten back above those moving averages. So if you go back and look at other periods like this, well, you could really almost say this period looks a little bit like it, but you can see the kind of move that's coming off of it. So it's positive. Primary trend is up, 200-day moving average, 200-day moving average, S&P, NASDAQ, broken above the 200-day, looks very positive. This is good. Here's the price of oil. You can see the spike, and we're now pulling back. We're back below $92 a barrel. It's probably going to pull back and stabilize here, maybe consolidate, but I think the oil play is kind of come and gone. We'll have to see. New lows have really dropped off, very positive. In other words, the way this indicator works is on the New York Stock Exchange, once the new lows get below 40 a day, it's somewhat telling you that the sellers have dried up. Now, the group that is really looking strong here, now we know the S&P is going to make a new high and possibly the NASDAQ, but look at the semiconductors. The semiconductors are taking a lead here. This is stocks like NVIDIA and many semiconductor stocks out there. But the point being is this is a risk-on group. This is technology, and we're seeing some strong performance here. So let me know if you have any questions. Thank you very much.